We are really digging into one of the most explosive single-day moves I think we've seen in a while in the microcap space.
Oh, absolutely.
We're talking about Innovative Eyewear Inc., ticker LUCY. It just rocketed over 47% in a single session, closed at 174.
And when you see a vertical spike like that, especially in a smaller company, it's just a massive signal.
Right.
It means the market has suddenly and pretty violently re-rated the company's entire potential.
Yeah.
This wasn't just market momentum. This was driven by very specific, very concrete news.
Absolutely, and that's the big question, right? The one everyone is asking and the one we're here to tackle based on this analysis report. Is this surge actually built on something real?
Something sustainable.
Exactly.
Yeah.
Is this, the next big AI hardware runner, or are we just looking at a classic flash in the pan?
And that's our mission today. We need to move past all the noise, past the hype. We're going to do a surgical extraction of the facts.
The catalyst, the tech, the numbers.
The numbers. We need to figure out if this microcap is actually positioned for the long run, or if the risk of it all falling back to earth outweighs that, massive upside.
Okay, so let's start where the action started, the catalyst. Because the AI story is, let's be honest, the sexy part. But the rally itself is grounded in a preliminary sales data release. The market moved because of tangible numbers.
Precisely. For small cap companies, growth velocity is everything. And what the analysis highlighted wasn't just, a little bit of growth. It was a significant acceleration.
Let's get into those two key figures then, the ones that really triggered this whole thing.
Okay, so the first data point, this shows their near-term execution is strong. Their expected Q4 revenue is set to hit roughly $1 million.
Okay.
That represents a 45% increase year over year. Just think about what it takes to generate that kind of growth in specialized hardware. That's rapid scaling.
45% year over year is already really impressive. That signals real demand. But I think what really grabbed the market was the forward guidance. That's what caused the massive volume, right? What were the projections?
That's the crucial figure. The company is projecting a full year 2025 revenue of $2.7 million.
Wow.
And that translates to a massive 65% jump from their previous year. So for you, the listener, when an investor sees growth accelerating like that from 45% now to a projected 65%, it suggests they found an exponential curve.
That kind of growth rate is exceptional. But here's my question. Does the analysis report give any context on how they plan to finance that kind of scale? A 65% jump?
That's a great question.
Because dilution is always the biggest risk with microcaps, isn't it?
It is, and the analysis doesn't detail specific financing plans, but it leans really heavily on what it calls the golden nugget as justification.
The golden nugget.
Yeah, the idea that they can afford this growth because of their control over a very specific market.
And that's their market share on Amazon. Lay that claim out for us.
Management stated they now hold approximately 44% of the market share for smart safety glasses on Amazon.
Okay, so unpack that niche for us. Why is dominating smart safety glasses so much more valuable than, say, just general smart audio glasses?
Right. Well, the smart safety glasses niche is crucial because you're often targeting professional buyers, B2B, industrial sectors, people who need OSHA compliance.
So it's a necessity, not just a luxury.
It's a tool. Think hands-free access to information. You're on a job site, you need operational manuals, data, remote assistance. That drives really consistent high-value demand and probably higher margins than general consumer electronics.
So dominating nearly half of that market on a huge platform like Amazon that shows incredible product market fit. It suggests that 65% growth isn't just a hopeful number. It's built on real control of a lucrative segment.
Exactly. The market is finally recognizing the execution that got them there, and the growth is just them leveraging that position.
That foundation moves us perfectly into the core narrative then, the technology. Because great sales are one thing, but you don't jump 47% just for safety glasses.
No.
We have to talk about the AI layer. That's what's driving this AI runner label.
This is where the story shifts from solid execution to, massive potential. The reason they're classified this way is because of a seamless integration of a major large language model.
Give us the breakdown. What's the user experience like?
The Lucid brand glasses have voice activation, and critically, they've integrated ChatGPT.
Okay.
What's so fascinating is that this is like giving every pair of glasses a tiny, custom-built research assistant.
So a user isn't just, taking a call. They can ask ChatGPT a complex question, hands-free, right through their glasses.
Precisely. Imagine walking around, your hands are full, you need a specific torque setting or a definition, and you just ask your glasses, and you get an instant audio response. This puts LUCY right in the middle of the hottest part of the tech market right now.
Ubiquitous, hands-free AI hardware.
Exactly. The market has an insatiable appetite for any company that can plant a flag in that space.
It also seems to validate their focus on utility over just novelty.
Well, yeah. I mean, if you connect this to the bigger picture, it's about ambient computing, a microcap company successfully integrating the world's most famous LLM into a device. It shows the barrier to entry for specialized AI accessories might be way lower than we thought.
Which makes them a very attractive proposition for investors looking for that wearable AI exposure outside of, the usual big tech suspects. Okay, speaking of scaling, if they're really aiming for that 65% revenue jump, they can't just rely on niche Amazon buyers.
No way.
Which brings us to the brand recognition and strategic partnerships. Scaling up from where they are demands massive distribution and, I think, crucially, consumer trust.
They absolutely need that trust. And building a consumer brand from scratch it's a nightmare. It's expensive and it takes years.
So they're borrowing it.
It's a genius move, really, acquiring brand trust via partnership, especially when your product is eyewear, which is both a tool and a fashion accessory.
And the analysis highlights some really big, globally recognized names. Who are they partnered with?
They've got major licensing deals with 3 huge brands that cover a whole spectrum of consumers: Reebok, Eddie Bauer, and Nautica.
Okay, so Reebok gives you the fitness and athletic angle, which is perfect for hands-free tech.
Right.
Eddie Bauer covers the rugged outdoor utility segment, which links right back to that high-margin safety niche.
It does.
And the Nautica adds that specific, recognized style for just everyday wear.
It's a very strategic triad. These partnerships give them immediate access to diverse consumer segments and, more importantly, distribution channels they could never build on their own in the short term. And the analysis says they're rolling out these new smart collections in 2026.
But wait a minute, are these licensed brands truly an advantage? Or does it just dilute their own Lucid brand and, eat away at their margins with licensing fees?
That's a great challenge. And licensing fees definitely impact margins, there's no question.
Yeah.
But the analysis implicitly argues that the sheer volume and market acceptance you get from using these huge brand names more than offsets that cost. For a microcap aiming for 65% growth, you need guaranteed distribution.
So it's a trade-off. Lower margin per unit, but a massively bigger market to sell to.
Exactly, which is what you need to justify that huge revenue projection.
So this means the AI classes are going to be available under names people already know and trust. It adds a long-term credibility factor to this short-term surge story.
That's it. It suggests longevity, not just a one-off product launch. When you combine that accelerating growth with proven market share and major brand leverage, you get a very strong foundation.
Which brings us to the technicals, the chart. When a stock moves this dramatically, up 47% in a day, you have to look at what the price action is telling us.
It's paramount. And it's important to understand the context here. Before this news, the stock was just trading sideways. This surge was a decisive breakout, a violent shift in sentiment.
So what were the key technical levels that signaled this?
The analysis points out that the stock didn't just drift up, it decisively smashed through the critical $1.20 resistance level.
Ah, okay.
That level had been a ceiling for weeks. Breaking through 120 signaled the end of that consolidation, and it probably triggered a lot of automated buying.
And once that momentum started, where did it take the stock during the day?
It carried the price all the way up to an intraday high test of $2.
The $2 mark.
That is now the key psychological barrier. Investors love round numbers, and $2 is a major threshold. It's where profit-taking pressure is usually at its max.
But it closed at 174, so significantly below that peak. What does that tell us about the strength of the move? Is that a bad sign?
Actually, no. Closing at 174 is still incredibly bullish. It's well above the old resistance and where most of the day's volume was.
Okay.
It shows that buyers were actively defending the gains against profit takers all afternoon. It wasn't a total collapse, which you often see in, a quick pump and dump. Buyers held the line.
So $2 becomes the real test. If it can break past that, what's the upside potential, according to the analysis?
If LUCY can break and hold above $2, the next technical resistance levels are in the $2.50 to $3 range.
And that's supported by the analyst targets?
Strongly. The average analyst price target is sitting right around $3.06.
That's a major target. So if it gets there from the 174 close, we're still talking about another, 75% upside?
The potential is definitely there, if. And this is a big if. The breakout confirms by clearing $2, and that fundamental story keeps getting validated. The key takeaway for you, the listener, is to watch that $2 level like a hawk.
So when we put it all together, we asked if this company is a true AI runner or just a momentary spike. And what we've seen is that, there's a ton of volatility, but the foundation seems undeniably solid.
The bull case from the analysis is comprehensive. You've got a microcap with accelerating substantial growth projected at 65%. They have proven dominance in a strategic niche.
44% of smart safety glasses on Amazon.
Right. And they have the integrated tech that the market is desperate for right now, functional, voice-activated ChatGPT in consumer hardware.
Plus, they've de-risked their future with these huge brand partnerships. Reebok, Nautica gives them credibility and distribution.
This whole combination just positions them perfectly to capitalize on this wearable AI trend. They aren't just selling a gadget, they're selling a practical branded tool that uses the world's most popular LLM.
It's a compelling argument. It looks beyond the one-day spike and into a multi-year strategy.
Yeah.
But let me leave you with one final thought to mull over that kind of builds on this narrative. Given that a tiny microcap like LUCY can successfully integrate a powerful LLM like ChatGPT into niche hardware, does this signal a broader and maybe faster acceleration where specialized high-margin AI accessories, not just big tech devices, are what will soon define how we interact with AI every day?
That's a great question. The success of a small player like this really makes you wonder if the AI hardware race will be won by these huge, all-encompassing ecosystems or by a collection of highly focused, specialized accessories that just nail one specific use case perfectly.
Something to think about. Thanks for diving in.